All right, here comes the end of the chapter. This fourth section, as I've talked about a few times already, I just want to talk about the vocabulary of it. The problems won't be on the test. I feel like we've done adjusting entries, closing entries quite a bit. I just want you to see how they work for merchandising businesses because they really, at the end of the day, are pretty much the same. But today's focus will be definitely on how to create a multi-step income statement. Clicker. There we go. Is it flashing by you guys? Yeah, that's what I thought. Adjusting and closing entries usually are happening at that end of that accounting cycle. For a merchandising business, keep in mind before we've always talked about sales-based or service-based businesses. Now we're selling stuff. Adjusting entries really are the same. Remember, adjusting entries at their very premise are to show what was used. You'll see one additional adjustment, basically to get our books up to date with what's actually happening on the sales floor, like what's actually left for inventory, on the store floor, in the back room, and even in off-site storage. So it's just a way to get everything up to date. And when you do an adjusting entry for a merchandising business, it involves updating inventory and updating cost of goods sold. Like I said, we're not going to actually do it. I'll show you what it looks like, but you just need to know that it's essentially the same. If there is one that's done, it involves inventory and cost of goods sold. What does it look like? Suppose PW Audio had an unadjusted balance of $40,000 in merchandise inventory. So they're saying in inventory, we hadn't really updated anything. We started with $40,500. Through a physical count, they determined its actual merchandise inventory was $40,000. The company would make the following adjustment. So it looked like we had more than what we really do. So you would see inventory go down and cost of goods sold go up because there's really a difference of $500 more at the beginning. Just force it. Now, had we had more than what we started with, that would all be flipped. So that's the basic premise of the adjusting entry. Do you see why we aren't going to do much with that? Just wanted to talk about it. Closing entries are the same thing. Remember, there are 4 closing entries. We close sales into income summary. We close all of these expenses into income summary. The biggest difference here is just a longer list of them. Look what shows up here is called freight out. So far, everything with freight, when we pay freight, is masked where? Under what account? Inventory. That's when freight's coming in, and we have to pay to get it to us. When we have freight going out, that is considered an expense. So when we pay for freight to come in, that's masked as inventory, increasing the value of it. When we pay freight to leave, that's considered a business expense or an operating expense, and it's called freight out. I'd even add the word expense to that. We'll deal with that a little bit today. The third closing entry is to close income summary into capital, and the fourth is to close drawings into capital. Again, that's all what we did last chapter. It's essentially the same. It's just this is a little bit more involved. So let's move on to the last section. Last chapter, chapter 4, we talked about the classified balance sheet. We're not going to do much with it, but the multi-step income statement would be very similar. There's just lots more hoops to jump through to get to that net income. I'm not going to have you do anything with a single-step income statement. A single-step income statement is revenue minus expenses equals net income. We are going to focus, though, on the multi-step, which, like the classified balance sheet, just has a lot more section, a lot more bulk. Okay. You have this slide in your notes. I gave you the slide that looks like this. This is the end one. What all of my slides do is they talk about each section step by step. So if you want to make notes out here on your left margin or write as I write, right now we're going to talk about net sales. Net sales takes into account revenue minus all of the contra revenue accounts we learned about yesterday, sort of. Gross or cost of goods sold doesn't show up till later. So we know that there's 3 things that offset revenue. 2 are truly considered contra revenue accounts. And if there were sales returns and allowances or sales discounts, we have to take that off of sales to equal what's called net sales. Be careful to not put cost of goods sold up in net sales. Okay, so if you're going to star anything on here, notice where cost of goods sold is. It's not up in the contra revenue section. So we say revenue minus our contra revenue equals net sales. Then we take into consider gross profit does include less cost of goods sold. So if you look at it, this whole top section has to do with revenue. You might want to draw a line on yours that way. It's just that there's 2 little hoops. First we have to say what were the net sales, and then we need to say what was the gross profit. What you need to know about net sales, that's these 2 contra accounts. What you need to know about gross profit, that's when COGS plays into effect. Then we can take a look at our operating expenses section. All the expenses and then this little curveball. Someone tell me the difference between freight out or freight in that's masked as inventory. I just got done explaining it. I would add the word freight out expense in there. Sydney, let's hear your take on it. Good. Freight in is when we pay to get what we purchase to us. Freight out is what we pay as an operating expense to send it to the customers. Could draw a line there. That's really where most of your multi-step income statements will stop. There's what I call a riffraff section. Again, non-operating activities. So money in, notice this is revenue, money in from stuff that doesn't pertain to the operations of our merchandising business. So if we earned interest revenue, or if we sold a plant asset and made some money off of it. Remember, plant assets are like PPE. Does Willie's selling a whole fleet of their old shopping carts contribute to the revenue of why they're in business? So if Willie's buys all new grocery carts, and they're going to sell their old ones, are they in the business of selling grocery carts? No, they're in the business of selling food. And so the revenue, the true revenue comes up here. Down here, this is like other revenue. Like, oh, we're going to sell stuff that we normally don't sell. So then it's in a little riffraff section. Or if Sweet Lily's decides to buy a new delivery van and they sell their old one, are they in the business of buying and selling delivery vans? No, they're in the business of buying and selling flowers. So that sale of something shows up down here instead. And then there's, of course, other expenses. So expenses and losses that have nothing to do with business. So if I have interest expense on a loan that I owe, or someone vandalizes the place, that money has to come out somewhere. It's just not part of the operating expenses. It's other expenses. So basically, if you don't know where it goes, having this riffraff section at the bottom. I don't think I gave you this slide. Did I give you this slide? This is really nice. Look at how it lays everything out. I would assume that's in the book somewhere, but if you want to take a picture of that with your phone and then add it to your notes or go find it in the book, this is a listing of all those non-operating expenses. Money in and money out. They're not called revenue and expenses. It's just gains and losses, basically, that are not because of the livelihood of their business. Willie's is not in the market of selling grocery carts. But if you sell them and you make money off of them, it's considered revenue. It's just not like operating revenue. One more thing, and then we're going to do our problem. Again, here's the simplicity of a single step. You will be doing everything multi-step. For the first time, you are being introduced to what I call ratios. Ratios start trickling in, and they're meant to be, I guess I don't see the word up here, but they're meant to be for the bigwigs to analyze. You as the accountant are doing all the grunt work, and then you show them a ratio. Today we're going to talk about the gross profit rate, and they can analyze it year to year. I know that ratios get covered in the BPA contests. So as we start adding into more of these detailed chapters, it will help you in other places. I know that some of the FFA contests, when they get into the real meaty financial stuff, ratios come up. Because it's the analytical tool that people use to put a finger on. That's what's happening with gross profit. That's one of them. Here is the equation. Gross profit divided by net sales. We know that the net sales is the top part. Gross profit's the bottom part. When I say top part and bottom part, all pertaining to the revenue section of the income statement. Another piece that you might add there, gross profit, is when we've calculated our COGS. Net sales are when we've calculated our contra revenue accounts. So net sales says, here's our money in minus what people returned, and the other one, I'm drawing a blank, sales discounts. Gross profit takes into account net sales, but then factors in that other contra of COGS. Basically, what does it mean from the analytical approach? It represents our merchandising profit. And I love this statement. How many cents of each sales dollar truly is our profit? After we've taken off the people that return stuff, the people we gave discounts to, and the fact that it wasn't free, how many cents on every dollar is truly like our rich gross, like what is our profit? We still have all the expenses that chip away at that ends up being net income or loss. But from an analytical standpoint, if your gross profit rate is really low, we better manage our inventory better. We better make sure stuff's not broken so customers aren't coming back and returning. Okay? We should maybe find a cheaper wholesaler where we can have less of a cost of goods sold. So that's what the analytical people in the business look at. Okay, if I'm selling cans of corn at Willie's, I'm selling them for $10 and I'm only cost of goods sold was $9. Well, maybe I should find cheaper corn to buy. So I make more of a gross profit. I have higher cents on each dollar that's coming in. Okay. I knew the analysis piece was on there. It allows who's ever buying our stuff to monitor it. And prices fluctuate, I get that, and they get that. But just overall, you're going to want to, they call it watching the bottom line, and that's what this is. We need to keep our gross profit rate high so we can have as many cents out of every dollar that we sell back into our business. Let's move on to this. Let's do this. Let's put it into action instead of just talking about it. We are going to create a multi-step income statement. And in this problem, calculate our gross profit rate. Again, how many cents of each dollar is true profit? Keep in mind, expense, expense, expense. We'll chop that down even further, but that's what's considered the gross profit rate or ratio. Furlough is at the company. I'm on page 255 in the book. Do you have 2 columns? Okay, good. I don't want you to write all this yet, but this is just what we're looking at from a vocabulary standpoint. And in its most simple form, it's revenue minus expenses equal net income. We know that. That's a simple income statement. We're just going to add a lot more complexity here today. I see a net income, and what does that simply mean? Revenue are greater than expenses, but we know there's a few chops to our revenue before we can even start talking about expenses, okay? So our first heading, do you have headings in there or not? Nope, sales revenue. Sales revenue is our first heading. What I need you to do is look on page 255, and do you see revenue anywhere? Sales revenue of $380,000. Are we sitting high on the hog here? Are we making $380,000? No, we're not, because there's a lot of chopping that's going to happen. I hate to be a spoiler alert, but our net income is going to be, out of that 380, 44,000 we're going to get to keep. Now, there's 2 little hoops that we have to jump through. We first are going to subtract off, in this case, 2 things. We're going to subtract off these 2 contra revenue accounts. Revenue has a credit balance. These run debit balances to offset that credit. Sales returns and allowances and sales discounts. Remember, this is us selling to, if we're a wholesaler, we're selling to a retailer. If we're a retailer, we're selling to a customer. This is us selling to someone. Unlike when we're buying, it's all masked in inventory. When we're selling, we have these 2 extra contra accounts that offset it. Okay, we had $13,000 worth of stuff come back, and we had $8,000 worth of sales discounts. And you might say, from an analytical standpoint, Scrap the discounts. Quit giving people such a deal on paying their bill early. But in a liquidity, from a liquidity standpoint, don't you think we want our money somehow? And if it means giving them a 2% off deal because they pay sooner, quit your belly aching and take the hit, right? Now, you'll notice what the book did. I guess I would like to see a line that says, well, yeah, I guess that's okay. I was going to say, I want to see a net sales line. I guess it's there. I just think this gets a little bit messy in here when they take the total of these two and put over there, but whatever. If you want to put like a, I think what did I do when I wrote it out? I said total contra revenue and had 21,000 on its own line. But if you can run this way, that's okay. So that 380,000 is already getting chopped up, minus its 21,000 of contra revenue. Our net sales are considered 359,000. Now, if you have a highlighter, it might not be a bad time to get that out. Sales revenue, the 380. Net sales, 359. Now, why I'm having you highlight is because these are kind of like the big hoops of the multi-step income statement. You're also going to need them later to do a ratio, so it's going to help to have them blatantly listed there. What else do we have to chop up off our sales? Cost of goods sold. I'm cool with you putting COGS there. When we subtract off our COGS, what's that next hoop that we've accomplished? Gross profit. Another item you'd want to highlight. So net sales are the two contra revenues. Gross profit subtracts off COGS. You gotta just memorize that. Okay, are we done with the money in section? If we had more money in, like we sold a plant asset or we made money off some interest, would that go up here anyway? No, because those are the non-operating revenues and expenses. I'm going to be honest, there are none on this. So you sure can do something like this just to divide up money in versus what we're about to do the money out. Now you might say, these contra revenue counts are kind of money out. Well, no, they're just offsetting our revenue, not necessarily seen as an expense. I think I called them yesterday, I called them expenses cousin. Our next heading would be operating expenses. I'm not trying to make this an art project, but another something that you could highlight. Here is where you will put a listing of all of the expenses. And then there's this little grrr, freight out expense. And Sydney did a nice job explaining the difference. Freight in, when we get our when we purchase stuff, freight in is masked as inventory. Freight out is the expense of us sending it to our customers. They've beautifully itemized the total and put it on one line. probably worth another highlight. And at this point, we're taking a look at gross profit minus total operating expenses to be that $44,000 net income. The bottom part, I think, the money out is pretty easy, minus that new freight out expense. The top part, I think with some practice and some memorization, I think you'll be okay. There's definitely a difference between net profit and net sales and gross profit. Speaking of that, let's do the gross profit ratio or rate. We take a look at gross profit divided by net sales to turn over a 40.95% answer. In dollars and cents terms, we're making about 41 cents for every $1 sold. Is that pretty good? Really good. If you could get it even higher, that'd be better, because we have $103,000 worth of expenses that have to come off of that. But you start getting into less than 10 cents on the dollar that you're making, you're working way too hard. Your time is more valuable than that. So then you need to say, we need to find cheaper cost of goods sold. We need to maybe lessen the returns. You could argue quit offering that 2% discount. That's what the job of the upper management to make those decisions. Have you ever heard of what are called buyers? Like in big businesses, oh, I'm a buyer. I'm a buyer. Well, that means they're buying the inventory that the business sells. Well, the buyer needs to do a little bit better job of finding more cost-effective stuff. So that's it. Holistically, I think it makes a lot of sense. We get to finally talk analytical side of all of this. Since there's time, I think we should start our problem A. Before we do that, though, Ira, your question? Oh, let's hear it. Yes. Yes. And did sales go up? Did sales skyrocket? Right. I remember when that happened. Really? Because they've brought it back now. They're doing all the percentages again. That was like, what, 2-ish years ago? Yeah. Oh.